Hello and welcome to The Chart Show. I'm Victoria Scholar, and each week I'll be sharing my analysis on three key stories that are getting a lot of interest among investors. I'll be looking at them not just from a fundamental perspective, but with some technical analysis on the charts as well. This week's three charts are Microsoft, Credit Suisse, and Vodafone. Initially extending losses in the post-market session on Tuesday night, shares in Microsoft staged a turnaround after hours to close up over 1%. Fiscal second quarter revenues hit $51.7 billion, rising by 20% year on year and beating Wall Street's forecasts. On the bottom line, non-GAAP EPS hit $2.48. That was sharply ahead of expectations. Microsoft is among one of the strongest names in the cloud space, with its Azure platform growing by 46%, modestly ahead of expectations. The pandemic, of course, expedited this shift towards cloud services, with Microsoft benefiting from a sharp increase in demand for corporate software and services. Although this was a solid quarter, this performance was slightly slower than previous quarters. Investors, however, were upbeat about its guidance for the current quarter, which kept shares afloat after hours. Taking a look at the chart, although the stock made gains on Tuesday night, the stock is still in correction territory, meaning that it's more than 10% below its recent high. After a strong uptrend off the lows when the market crashed in the first quarter of 2020, right at the start of the pandemic, recently tech stocks have been under pressure, with Microsoft shares caught up in the leg lower. In terms of key levels, look out for 280 as the next major downside support, which roughly coincides with the October low. And if we see another move higher, it looks as though 300 is the next significant round number resistance to break. A push above could spur further gains. Shares in Credit Suisse extended losses on Tuesday after Monday's nearly 7% slump. The lender issued a profit warning for the fourth quarter amid fresh costs around litigation and a slowdown both in trading and in wealth management. The embattled bank has been struggling lately amid a series of headwinds relating to its former chair, who broke COVID rules, the Archegos implosion, the embattled Greensill Capital scandal, and former CEO Tidjane Thiam's spying scandal as well. The quick succession of leaders as a consequence is having a damaging impact on investor confidence and profitability. Taking a look now at the chart of Credit Suisse, shares have shed nearly 40% since the peak last year. Taking a longer-term view, the stock has been posting lower lows and lower highs, dating even further back to the peak in 2018, when the share price was more than double where we currently are. If we continue to see an extension of the downtrend, the next major support level is at around 643. That's the low from March of 2020. A break below could potentially point to further declines. If we were to see a slight reversion of the recent down move with some gains coming back into play, look for resistance at 10 and 1150, which is where the stock gapped lower this summer. A push back up towards 12 might reinstate some more bullish price action ahead. Shares in Vodafone jumped more than 5% at the start of the week on reports that it's in talks with Iliad to combine their respective Italian businesses. The tie-up deal aims to reduce the number of mobile telecoms firms in Italy from 4 to 3. It's understood that the deal would create combined revenues of nearly €6 billion, with a market penetration of 36%. This would likely be a welcome development for Vodafone shareholders, who have been suffering with a more than 25% slump in the share price since November of 2019, before the pandemic. Iliad has been exploring ways to expand in Italy, either through organic or inorganic growth, in order to minimise a price war that's creating a race to the bottom and a squeeze on margins. Let's take a look now at the chart, because we can see that the stock has been trading in an uptrend with higher highs and higher lows since the trough at the end of last year. Shares have rallied more than 15%, breaking above key resistance turn support at 120. Looking further back, however, off the March highs, the stock was under pressure, trading in a descending trend line. If we continue to see this uptrend making headway, then there's likely to be considerable resistance at the peak just above 140. That would require shares to close the gap from May. Before that, however, look for near-term resistance at 130.